board. We're thrilled to be working with Artis, a company from humble beginning that's now one of the largest players in the Canadian retail clothing industry for the women's sector. We're here to help you navigate the new horizons of the changing reality that your business is facing today. My name is Mark, these are my colleagues Kalina and Philip, and we are P&L Consulting. So, we're here really to help you pursue your growth plans, which are to expand your network of stores, to develop your online platform, and to pursue an international presence. Our mandate was how to raise 85 million to pursue those plans. We're going to look at, should we go with an IPO or raise debt on the market? Also, what is the valuation of your business? It's always a great thing to know for private owners how much their business is valued in their industry. And at the end, what the impact of a recommendation will be on the operations and the control of your business. So, without further ado, we advise to do it through an IPO, to issue Class B shares on the TSX market at a price of $16.39. This would be done through an IPO. We've worked with a business valuation of $3 billion, and we've structured it in a way that you'd be only giving up 3% of your ownership and remain the majority stakeholders in Artis. So, the industry at a glance. Your market is saturated. It is a market that is under consolidation. We've seen major players such as BCBG, Maxazeria fall down due to the high competition that the market is facing. There are over 3,700 players on the market right now, and those are majority of small businesses that derive their value from an offering of diverse and unique clothes. We can also think of Le Chateau who needs to restructure its operation because they're not part of the game anymore. There's also the Asian competition. They're coming from out of Canada. Today's barriers of commerce are broken down, and you can do business wherever in the world you want. They're able to derive low prices from their different realities in terms of laws and ethics, and they're declaring a price war on Canada's retail business. We need to face this problem. Also, the online sales. This is a new market for you, and you know it. You've been able to derive 12% of your sales last year, roughly $65 million, from your website. Also, we can think of Amazon, the major retail player in the world, who's able to do business with literally 0 stores. So, the woman retail clothing industry is under siege, and we need to change our way to do things. If we look at the industry as a whole, we can see that the revenue of the clothing industry in Canada is $6.1 billion. According to Statistics Canada, this is the largest second industry in the service area. This is huge. There are 3,756 players who compete for this portion of the market. In terms of growth, there are 2 ways now to conduct business, either in stores or online. In store, we can see that this is a 2.3% growth on a 5-year horizon for projecting the potential revenues. As online, it is 12.6%. So now you've taken the turn of going online, you need to grow this business, and you're well positioned to penetrate the future market. Company profile. Really, Artis is a strong company, and we can look at it from 3 points of view. You're using high quality and sustainable material. From its humble beginnings, the 2 owners have really focused on the detail of the business, and this is how they derive value from their products. They're using sustainable resources on one side because they believe in it, but an impact of this is there is a positive opinion of the public as today's reality really is oriented towards sustainability and the environment. And finally, 90% of your line is exclusive, so this targets the needs of women who are between 15 and 44, your target market. You're offering a premium customer experience. It's not everywhere that you can walk into a store and be welcomed by a personal stylist. You've made this option available online right now, and this is a lot of value for your customers. Your stores are tailored. Whether you're in Quebec or in Vancouver, your store really use local materials and tailor the configuration to the province they are. Customers do appreciate it. Finally, a personal touch would make you different from the other stores. You focus on art and music, a love of your founders, and you're really able to differentiate yourself from the rest of the market. So your positioning is strong in an industry that's changing. And now, dear Ms. Sandra, your parents will leave your company in a couple of months. You need to know from a financial standpoint where you're at. Right now, in terms of numbers, you have a profit margin of 6%. This can seem low, but compared to the 4.5 percent average industry, you do outperform your competitors. In terms of inventory turnover, so this is the time in a year that you're able to completely sell your inventory, and that money is not stuck in inventory instead of in your account. This is roughly every 82 days. It's a very, very good turnover. If we look at the enterprise value to EBIT ratio, your enterprise value is valued 12 times your EBIT, which is not abnormal, but also above your competitors. So you're able to derive value outside of your financing. And finally, your interest coverage. So this is how much time with the cash you're generating you'd be able to cover the interest from the debt you've raised. It's 4.8, so you're a healthy company and you're able to cover your interest ratio. So your strategy really aligns with where the market is going. You're doing it in an efficient way. And to go to the next step, we suggest you to go with an IPO. And my colleague Alina will walk you through a calculation for such a decision.
Thank you, Mark. So as Mark mentioned, the interest coverage ratio is at 4.8 times, which means currently you can cover your interest. What we wanted to look at as a team was the leverage profile of the company. So we looked at a couple of other ratios, which is the net debt to EBITDA and the net debt to equity. Now, we see that at 2 times net debt to EBITDA and 2.1 times net debt to equity, and as well with the interest coverage ratio of 4.8, which is lower than what the covenants, what the banks would impose on you based on the restrictive covenants, you would be breaking the restrictive covenants and thus would not be able to add more debt to your balance sheet. The way we calculated the net debt used in our calculations was by using the short-term debt, the current portion of the long-term debt, as well as the long-term debt, minus the cash and cash equivalents that we have now, yielding $166 million of net debt. Now, since we will not be going with debt, we will go forward with an IPO. Now, I want to talk to you about the drivers of how we drove the top line, our EBITDA margin, as well as how the sales breakdown is in the upcoming years. First, the sales breakdown, the way we did it is by understanding how many new stores you would want to open in the next 5 years. Based on your expectations, it's five stores additional per year, which yields up to 30 stores in 5 years. So currently what we did, we found the sales per store, and we were able to put a same-store sales growth of 5%. The reason why we chose 5% as a same-store sales growth is because we understand that the company currently is generating positive and high same-store sales growth, and in the retail industry, 5% is seen as a healthy and strong same-store sales growth, which is what we used for our projections for the top line. So this is part of the stores that we added in this revenue breakdown. But e-commerce is becoming more popular and a bigger part of your revenues. Currently, 12% of your revenues come from e-commerce. Based on your expectations as well, we forecasted having 25% of your revenues in 2021 coming from e-commerce. Now, going to our EBITDA margin expansion, as you can see here for the next 5 years, it goes in line with our assumption for the e-commerce. Since you're focusing heavily on e-commerce as well, this is a low operating expense model, which will allow us to have expansion for the operating income, for the EBIT, and thus yield an expansion in the EBITDA of around 1.5% in the next 5 years. Here, we can see that we're adding 5 stores every year up to 30 years till 2021. Now, the assumptions that we use for our discount rate used in our DCF, the risk-free rate was based on a 30-year Canadian Treasury bond yield. The reason why we chose the 30-year instead of the 10-year, for example, we wanted to be more conservative and take the highest yield that was given to us. The market return and the beta, which were available, yielded a CAPM of 5.26% cost of equity. Now for the WACC, the cost of debt, we use the interest divided by the debt that you have, after the tax rate of your company, with the after-tax cost of debt and the debt-equity ratio that was given to us again, we yielded a WACC of 5.2%. Now, in our DCF, the reason why we have 0 capex is because you are currently renting your stores. Thus, you don't have to use your capital expenditure money into building new stores from the ground. With the projections that we made for our DCF and our WACC, we yield an enterprise value of $3 billion. And with the shares outstanding that we currently have, the value per share that we come up to is $16.39. Now, you want to raise $85 million. So by having this share price, you would be able to issue 5.1 million shares, and then you would want to give a discount to the investment banks that you would be dealing with, and this is something that Phil will expand on based on the price that we would offer them. Now my colleague Phil will continue with the implementation that we recommend.
So we do know now that we would not be able to raise debt based on the fact that we are breaking all restrictive covenants that were issued to us by the syndicate of investment banks. As you can see on the net interest coverage ratio, which requires a 30 times interest coverage ratio, which is extremely high, as well as a net debt to equity of 0.25, which is extremely high as well. We could see that because the current environment for such retail store with the arrival of Amazon's breaking into the business model, could see a little bit of fears on the side of investment banks. Therefore, leverage profile does not respect the covenants issued by our bank. So now that we know that we can't do it on a qualitative factor, we want to on a quantitative factor. We want to look at the qualitative aspects of both a term loan as well as an IPO. So here are the pros and cons of an IPO. First of all, the major pros is that you'll have access to additional financing with the issuance of secondary offerings on an ongoing basis to finance your further capital requirements. Then, second of all, on promotion and reputation. An IPO is something that doesn't go by unnoticed and is usually on the top of the business section of the press. Therefore, you'll be getting another way to have marketing your project and your expansions on the Canadian basis as well as an American basis. Then on the compensation way. First of all, IPOing will be a way for your shareholders to take money off the table, which is something that they might want to do. And in addition to that, shareholders could be used as a currency in two manners. First of all, shares being traded on the market can be used into other corporate transactions such as mergers or an acquisition. And furthermore, it could be used as a way to compensate your employees. This is something that we understand you have dear to your heart as you're a well-run business, and therefore you'd be able to better align your employees with your corporate strategy by issuing a stock options plan. But there's also a few cons regarding an IPO. First of all, there's a scrutiny in the public. You need to disclose a lot of information, and you need to face investors on a regular basis each quarter. Then we know that the process of raising an IPO is lengthy and has a lot of fees associated with it. And lastly, that there is a shareholder dilution. This is why we propose to have a dual-class share listing on the TSX, therefore enabling us to protect the 70% control that you want to maintain over your business. Therefore, Class B would only be able to acquire up to 30% of the voting rights if secondary issuance would be going on. Now moving forward into the pros and cons of the term loans, because we also wanted to look at the qualitative factor behind that. So first of all, the pros is that there's no dilution since you're only issuing debt. It's a favorable environment currently since the interest rates are so low, and there's a lot of thirst for yields in the market coming from both international players as well as local players. Lastly, there's no reporting required as you will remain a private business. Then, on the con side, there's restrictive covenants that will not allow you to do any corporate transactions such as merger and acquisition, and also will have you to restructure your business in order to fit their own leverage metrics. Also, there's a recurring cost due to interest expense as well as debt repayment, since this is the way this is structured, as it is not able to repayment at the end of the structure. And lastly, there's a possibility of bankruptcy, as all your assets will be collateralized for this term loan. So now, looking forward into the implementation, what we're going to look at is what we do now in the next 3 years, and as well as the long term. So right now, what it's important to do is contact this investment bank syndicates. We've known that you've been dealing with the most renowned banks in Canada, and we do believe that they will be going forward with this IPO. Then we want to go conduct a roadshow as well as contact the Canadian Securities Association in order to make sure that we are adhering our prospectus in order to be in regulations with the rules of the markets. Also, thirdly, we want to recruit a VP Investor Relations. This is very key to relieve you from one of the cons of an IPO. We do know that facing the public scrutiny will derive some focus of your management away from their core operations, which they've been excelling to do. So by approaching an investor relationship vice president, this will allow you for him to conduct all the operations regarding the reporting, as well as facing institutional investors in quarterly conference calls. Then, lastly, you want to list on the TSX. We view this as being 6 months from now, and we would reach this objective by having a financing over the next 6 months provided by this investment bank syndicate. In the next 3 years, what we really want to do is to expand and improve the store network as you want. we really want to focus on North America right now, as this is where our expertise lies in. We do believe that we have a strong understanding of the Canadian consumer, and we are currently now penetrating the US. And there's still a lot of cities that are not being explored, particularly in the Midwest and the West Coast, which are two prominent regions in the US, as well as the prairies in Canada. Also, we want to develop e-commerce. What we really want to focus on in developing e-commerce is focusing on developing a mobile app. As we know, in 2016, the trends of smartphone is really something that is driving consumerism. Therefore, by developing an e-commerce app for your brand, we'll be able to have your customers not only transition from your website to their smartphones. Then we want to continue developing exclusive brands as we've been doing so good in the past, and we want to increase profitability. This will be driven by a shift towards more and more e-commerce businesses. And then in the long term, as we do see that you want to continue your international expansion, we do want to explore other markets that would be similar to the North American one, such as the European one. And we do not know exactly what the right strategy is right now, but we do see 3 further options if you decide to go further with our recommendation. The first one being an organic expansion, the second one being a merger and acquisition, and the third one being a joint venture. So now, looking forward into what are the risks and mitigation, what are the risks of this IPO? First of all, there's the risk that this IPO fails, then there's the public scrutiny, and there's the loss of ownership. So to mitigate the failure of the IPO, we decided to structure a bond deal with the investment bank. This is why we'll be offering them a discount at $16 per share instead of $16.39 shares, which will be able to resell at the market. We do believe also that the current capital markets environment has seen a fair rebounding from the 2008 crisis, and as we would say, the bulls are rolling. Then, on the public scrutiny side, we do believe that this will be mitigated by the implementation of our investor relations divisions, and by having a strong management that we've been having over the past since the founding of this business, has made this business fairly attractive to the public. Lastly, for the loss of ownership, this has been fairly mitigated by the dual stock ownership. Therefore, your Class A shares, which will remain with the family, won't be sold to the public, only the Class B shares. And therefore, even if we do secondary offerings, we will never exceed that 30% dilution that your family is expected to do. So all in all, Artis is currently well positioned to go forward with this IPO, and which will enable it to go forward with its goal plan. So in conclusion, we do recommend raising $85 million through a public listing of Class B shares on TSX via a bond deal. So therefore, we will be answering the 3 considerations. The first one being to go forward with an IPO. The second one being what is the value of this business. We do see by our DCF calculations that the internal value of this business is $3 billion. And lastly, the dilution profile, since we only be issuing $85 million out of a $3 billion company, would be only 3%, which would be done through Class B shares, which would also protect the family's ownership in this business. Alors, messieurs les juges, merci beaucoup de nous avoir écoutés aujourd'hui, et nous ouvrons le plancher aux questions.
So, I've got a question regarding the IPO that you're offering. You're saying that we're going to have a multiple share structure, right, in order to keep the voting rights under us, but we're only giving out pretty much 3% of the company, of the capital out there. Aren't you afraid that it's going to have a bad impact on the perception from the market that not only are we only giving out 3%, which is a dismal control to start with in the company, but we're also already creating a dual share structure in order to retain even more control in the hands of the founders?
So we do see that this could be seen negatively in the capital markets. However, since we are a Quebec-based company, and we do see that many flagship companies such as Bombardier have a dual listing, we do see that the institutional investors are acquainted with such concept, and this could be seen as a positive for institutional investors to buy further on secondary offerings.
Merci pour la présentation. En fait, parlez français. En fait, vous avez déterminé la valeur de l'action, la valeur de l'entreprise, mais dans vos calculs, vous avez considéré que les capex sont nuls. Pourriez-vous nous expliquer pourquoi?
Oui, la raison pourquoi, c'est parce que they're renting their stores, and therefore they're not building their stores from ground up. Therefore, they don't need any capital expenditure to build new stores because they're leasing. Which is why we we had the assumption of 0 capex per year, and also because we looked at the past year, which we have more clarity on, to look at the property, the PP&E difference, and the difference was not positive, which means even though we were adding stores, they had added 10 stores in the last year, and there was no capital expenditures going in those stores, which is why that's how we got the assumption.
J'aimerais savoir, connaître votre opinion sur votre vision des marchés financiers, puis comment vous pensez que l'action de la compagnie pourrait se comporter via des futures fluctuations.
Et on a pu voir que vraiment le marché du retail est un marché qui est perturbé, majoritairement par la façon que les Américains permettent de conduire la business sur l'Internet. Alors c'est sûr que c'est une action qui, on pense, n'aura pas une très haute demande dès le début, dans le sens que le prix, notre offering price va être probablement similaire au closing price sur la première journée. C'est une action qui va être stable, par exemple. Puis on pense qu'au Québec, il va vraiment avoir les banques vont pouvoir encourager et les portfolio managers vont être capables d'encourager la vente de cette action-là parce qu'on a un entrepreneurship value in Québec et on pense que réellement on va être supporté par le marché québécois puis on va pouvoir continuer notre expansion après ça à l'international.
Okay, going to go. You clearly demonstrated that debt is a major factor of why our covenants we couldn't make it, right? But I'm going back to that 3%. Don't you think we should maybe go to 5 and then take that extra cash in and then rebalance our balance sheet in order to kind of get ourselves closer to what the market kind of looks like for our business segment?
So we do have noticed that our covenants are very restrictive. And we do not believe that this reflects the current environment in the retail space, as we do see an interest coverage ratio between 2 to 6% for the majority of the players within the retail space. Therefore, a 30% interest coverage ratio is fairly restrictive on such a business. This is probably due, as I've mentioned, by the presence of Amazon disrupting the businesses and sending a negative view towards the investment banks who are maybe a bit greedy on their terms.
So you're holding the structure as it is and just giving 3% out?
We do see that additional cash flows generated by growth will be able to help us pay down that debt, and which on the long term will help us delever and diminish that ratio.
Okay, thank you.
Merci.
Merci.
Question.
Ouais.
Merci.